Bonjour tout le monde. Good morning, everyone. My name is Robert Giroux, and I'm a volunteer with the Ottawa Branch. I would like to begin by recognizing that the Ottawa Branch is located on the unceded territory of the Algonquin Anishinaabe Nation. We extend our respect to all First Nations, Inuit, and Métis people for their valuable past, present, and future contributions to this land and our country. On behalf of the branch, I'm pleased to welcome you to today's webinar, which is titled Renting versus Owning, the Glory Days of Real Estate Are, in brackets, Still Over. Today's presentation is with none other than Michael Fine, who is a branch member and longtime presenter with the Ottawa Branch. Over the last 7 years, Michael has developed and offered very popular workshops and webinars on investment matters that have reached over 2,000 of our members. Michael has an MBA and has successfully completed the Certified Financial Planner courses, although he has never worked in the industry. He has spent a lot of time managing his own family's financial affairs, and his views are his own, and he receives no remuneration for these events. He is dedicated to helping retirees get the information they need to make well-informed decisions. Thank you for being with us this morning, Michael.
Thank you.
Veuillez noter que le webinaire sera présenté en anglais, mais la participation bilingue est toujours encouragée. I also want to give a special welcome to anybody here who is not yet a member of the association. We hope these webinars will inspire you to join us. And to our members, we hope that these webinars will encourage you to maintain your membership. Michael has also designed some poll questions for today's presentation. During the corresponding point in the presentation, a poll question will pop up on your screen. Select your answer and click Submit. Michael will then discuss the results. These polls are completely anonymous. If you have any questions for Michael, please type them in the Q&A box, and he'll be able to answer them at the end of the presentation. Well, that's all for me. So I'll pass it over to our presenter, Michael Fine. Michael, over to you.
Thank you very much, Robert. Et merci d'avoir accepté d'être là de ce webinaire. I'll just, ladies and gentlemen, get my PowerPoint up and going here. Okay, so what we're going to talk about today is the fact that the glory days of real estate are over and why. And I'll take a few minutes to run through basically what's happened a bit in the past and try to give you an idea of what we may be able to expect in the future, as well as give you some hard numbers that compares the cost of renting with the cost of owning. I just want to reiterate that this presentation is for information purposes only. It does not constitute advice, and you're urged to perform your own due diligence before making any decisions. So here's the first poll question. If you can bring it up, Antoine. Do you currently own your own home with no mortgage, own your home with a mortgage, or rent your home? Please vote now. And Antoine, I'll let you decide when enough votes have been cast.
We're still getting some votes here, so okay, I think we're good. So I'll show the results.
So 76% of you own your home with no mortgage, 17 have a mortgage, and 7 are renting. I asked this question up front because I wanted to be able to tune my presentation to those who are attending today. And glad to see that so many of you own your home with no mortgage. So let's go to the next question. So what factors do you think affect the price of real estate? And Antoine, bring it up. So interest rates, population growth, economic growth, the supply of new construction, or all of the above? Please vote now. All of the above. Yes, you're absolutely right. All of these things, and we'll discuss them, affect the price of housing. So let's take a look at them. So let's start talking about interest rates. First of all, and perhaps the most important message I want to leave you with today, is that the last 40 years, from about 1982 to 2022, were exceptional times. And I'm going to show you in a minute why I don't think we're going to see anything like those times from an interest point of view in our lifetimes. Because basically, as I'll show you in the next slide, there were 40 years of declining interest rates from 1982. Those of us on this webinar can probably remember 18% interest rates back in the early 80s when some of you bought your first homes. Now today, we've got massive government deficits and debts. In the United States, the debt is going to hit 34 trillion this year. Just the interest payments on that alone at 4.2% is $1.4 trillion per year. That's more than the United States pays for its military. So who funds this? Well, the bond market funds it. And what's the bond market? The bond market is basically pension funds, sovereign wealth funds, all sorts of people, insurance companies who buy these bonds and pay for all this debt. And I'm going to show you in the next slide the result of all this debt. So here's a chart of the 5-year US government bond interest rate. And I use this one simply because it's the easiest one to get data on. But if you see back here, about 1982, that's when their interest rates hit 16%. And if you recall, went all the way down 2022 to virtually nothing, half of 1%. And since then, it's come up substantially as these debts have risen, the economy has improved. And today it's sitting at about 4.2%. But here's the point I want to make. From 1982 to 2022, the interest rate dropped by 15 percentage points. It went from 6 to, let's call it 1. That has had a huge impact on the price of all assets, real estate, stocks, bonds, whatever. And here's why. As the interest rate went down over this 40-year period, the amount of mortgage that, say, $1,000 a month payment would support went up. So interest rate went down, the mortgage available went up. So where do you think that extra mortgage availability went? Well, it went straight into the price of housing because people were able to pay more. And in the future, we can't go from, say, where we are here at 4% down 15 percentage points, because that would take us to minus 11, and you can't have minus 11. So my point is that this 40-year period were the glory days, and it pushed up the prices of everything, bonds, stocks, real estate, and it cannot happen again. And economists and others have calculated that this interest rate effect accounted for about 40% of the increase in the price of real estate. 40%. So if we see this 40% reduction and apply it to the average increase in Ottawa house prices, which was about 5.6% during the 2002 to 2022 period, our estimated price increase going forward is probably around 3.4%. That's if everything else stays well. Remember, we looked at things like growing economy, growing population. 3.4% instead of 5.6%. So that last slide that I showed you is, I think, the most important thing for you to take away from this presentation and to understand. And that's why I say that the glory days are over. So take a look at population and what's happened in population in this country. Well, population growth is declining. And here we are in the last few years as we got up around 40 million in population, but our annual growth rate is down below 1%. And as you know from the news you've been hearing, without immigration, it would be zero. And now the government has had to cut back substantially on the amount of immigration. So our population growth is going to be down about here. And what about economic growth? Well, the government talks about GDP growing, but that's not the real important measure. The real important measure is GDP per person. And the problem is that GDP per person has been going down. And this graph only goes to 2023, but in 2024 numbers, it's down again. So we have declining GDP, declining wealth, declining economic activity. So it all comes down to basically affordability. And here's a quote from a recent article from BMO, Bank of Montreal Capital Markets, saying the great Canadian real estate stagnation has just begun. Why? Prices are just still too high. People can't afford to buy anything. I have a daughter in a family relationship where two of them make about $105,000 a year, which happens to be the average Canadian family. They can't even think about buying a house because the minimum it's going to cost them for a townhouse is $700,000. And mortgage rate interest declines have not been enough to offset these rising prices. So housing remains unaffordable for almost any new time buyer. And then the other thing that's affected it, and we'll look at this a bit, is that investors now need to put down at least 50% on an investment property to get a positive cash flow. So all these things are negative for the price of housing. As I mentioned, it doesn't make sense as an investment anymore. Prior to 2018, you could put down 25% and get positive cash flow. And at a 5.6% price gain, that equaled a 20% return on investment because you were putting down a quarter of the price, but you were getting this 5.6% price gain over the whole price of the property. So property has been, up until say 2020, 2022, a great investment for people, but doesn't work anymore. So here's the next poll question, talking about the environment that we're in. So how will a new federal government affect the Ottawa housing market if there's a change in the political party? So vote now, please. Antoine? Okay, Antoine, what's the result? Well, so 69% think that demand will decrease. Ottawa's in obviously a rather special situation because we're so dependent on the government. But clearly, this is another factor that we have to consider here in Ottawa, that if we get a government in that wants to cut spending in government, then it's not going to be very positive for the housing market. The other thing that's interesting is the amount of rental properties being built. I don't know if you've looked around, but it seems to me that there's construction cranes and rental properties being built all over the city. And in fact, and this is only partial numbers here, but the dark blue bands here are the number of rental units being constructed. And as you can see, they're at pretty much record numbers. So huge numbers of rental properties coming on the market, which again is going to increase supply and which is already driving down rental rates in a number of Ontario cities. So my conclusion, to repeat, is that the glory days of real estate price increases are over. So let's turn to the next part of the discussion, which is real estate a good investment at all now? And are you better off renting versus buying? So I did just some basic calculations here. So if we take the average increase in real estate residential in Ottawa over the previous 10 years, the value, and start with a condo, say, valued at $380. After 10 years, that will be worth about $655,000, and after 20 years, about $1.1 million. But I put in a couple of dividend exchange traded funds just for comparison. So these are safe, conservative funds that pay, say, a 4 or 5% dividend. Well, if you left the dividends reinvested in these, this one, XDV, yielded about 7% over the past 10 years, and VDY yielded about 9%. So if you just invested in those and had them in, say, a registered non-taxable fund, XDV would be worth $748,000, VDY $899. But look here, after 20 years, VDY would be worth almost double what the same amount of money invested in, say, real estate would be worth. And that's using the last 10 years numbers, not what might be in the future, because we don't know the future. And I know people will say, yeah, but if I invest in housing, make money, it's not taxable. Well, what a lot of people aren't aware of in Ontario is that if you have Canadian dividend income of under $57,000 a year, there's no tax on it. And so it means a couple could have dividend income of $114,000 a year and not pay tax. Pretty neat. So let's look at comparing renting versus owning, which is what this is all about. So here is a $380,000 condo bought for cash, no mortgage. And these are real numbers that have been provided to me by one of our colleagues. Won't mention her name, but thank you very much. So condo fees, insurance, tax, maintenance at 0.5%. So if you have no mortgage, your cash flow on this is about $14,000. In other words, what you're going to have to pay out. And the rent on that condo is about $2,200 a month. So the cost of that is about $26,400. So the cash flow total difference is about $11,000 a year. So that means that if you don't have a mortgage, you're ahead by about $11,000 a year on cash flow. But, and this is a big but, if you were to take that difference in money and reinvest it in one of those dividend ETFs I showed you, you would have this additional opportunity cost or opportunity value of about $13,000 a year. And in that case, what happens is that it's pretty much a wash between renting and owning, because as long as you take that extra savings from cash flow and invest it in, say, one of these dividend ETFs. So I hope people understand that concept. Now, let's look at the same unit where that you bought for $200,000 cash with a $180,000 mortgage. Same condo fees, but now you've got this mortgage payment and your cash flow is $26,400 roughly. And the rent is $26,400. So the basic conclusion here, not to get too complicated, is that if you've got a substantial mortgage, then renting or owning is basically a tie. Let's look at a more expensive unit. So this is one bought for, say, $900,000 with no mortgage. Again, these are real numbers. So you've got condo fees, insurance, rate maintenance. A lot of people, by the way, ignore this number, maintenance and repairs, but it's something that you have to put in because you may not have to pay it every year, but it accumulates over time. Things depreciate, things break, and these are real costs. So in this case, your cash flow cost is about $25,000. And the rent on a property like this is about $48,000. So in this case, from a cash flow point of view, you are definitely off better owning. But again, there's this opportunity cost. What you could do if you invested that money in, say, dividends versus in real estate. And when we throw that in, we get a total of $57,000. So you end up with a difference of about $9,000. So it's not huge. Now let's look at if you have a mortgage. So let's assume you bought for $500,000 cash, $400,000 mortgage. Same numbers. Your cash flow cost is $50,900, and your rent is $48,000. So again, in this case, renting or owning, it's pretty much a tie. It's close enough that there's enough variables in here that we're not going to worry about it. So what's our benefits of costs of ownership? Well, you get tax-free capital gains on the primary residence. You have fixed payments. You control your future. But you also have condo fee increases, tax increases, unexpected repairs, lots of things going on. What about renting? Well, the nice thing about renting, of course, you have no repair bills, no maintenance, but you can also face potentially unresponsive landlords, uncontrollable rent increases in newer buildings. By the way, in Ontario, any building first occupied before November 15th, 2018 is rent controlled. So if you're looking for a building where you can be more certain of the rents, find a building that is rent controlled. Newer buildings have high rents. I've seen 2-bedroom and bath apartments in new buildings in Ottawa that are renting for $5,000, $5,500 a month today. And the last thing to worry about in renting is rent evictions, where the owner says, well, I'm going to renovate this whole building, and essentially everybody's got 3 months to leave. So what are the conclusions here? Conclusion is if you own a home worth $900,000 or less, if you've got no mortgage, then the cash flow is much less than renting. If you've got a substantial mortgage, then the cash flow is about the same. It's a saw-off between renting and owning. But if you can invest the cash flow saved by owning, such as when you've got, no mortgage, then you are substantially better off if you can take that money and invest it properly so that you basically win by taking the extra money that you have and investing it properly. So just before we close, we've got a little anthem here about the glory days. Hope you enjoy it. All right, glory days. And just to show everybody that I actually did get this hat in Italy. There I am sitting wearing this hat in a place called Lucca in Italy, which is about 45 minutes west of Florence. Great little city. If you ever have a chance to be in Tuscany, highly recommend it. And with that, I turn it back over to you, Robert, for some questions.
Thank you very much, Michael. Anonymous spectator said, the first question, so depending on when you bought your house, i.e. 1999 versus price today, even with a 40% drop, the house could still have a good gain. Did you answer that, Michael?
Yeah, just repeat that question for me, Robert, as I try to get this working properly.
Okay. So depending on when you bought your house, i.e. 1999, versus price today, even with a 40% drop, the house could still have good gains.
Oh, for sure. The gains are still there. And, one of the reasons that people can't afford houses is because the prices have stayed so high.
Are we okay to go to the next question?
Yep. I'm just trying to figure out why I can't see myself here.
Well, this one is rather long, so I'll go very slowly. Do you recommend for a single pensioner, A, continued ownership in an existing home with its inherent maintenance, B, a move to a condo with no maintenance but associated fees, or C, sale of current home and move into a rental unit with no rent protection to units built after 2018? Do you want me to repeat them again?
No, I think I got it. That's a tough one. A lot of it depends on the the individual's age and stage of life. Um, my general feeling is that if your accommodation is still suitable for you and you don't have a mortgage, you should probably stay where you are. But if the maintenance is becoming too much, or it's just something you don't want to bother with anymore, then move to a rental. But it's really a lifestyle decision. And I know in my own case, for example, we have a single house with a very, very large lot, and it's way too much work. And I would like to sell and move, but frankly, I can't find anything to move to. So, when I find that right thing, I'm going to move. But right now, I'm not there.
Okay. The next one has identified himself, Michael Haddad. Michael, with respect to your slide on real estate investment growth versus ETFs, how do you factor in the cost of home ownership over time?
Well, that's a good question, and it is an extra question, and I haven't factored it in. I just looked at the overall return, but typically the cost of home ownership is running about, say, almost 2% per year. So you've got, for example, maintenance, you've got taxes, and you've got just general upkeep. So that's a very good point. So if you take off that, say 2% per year, you're left with 3.6% per year, or maybe even less, which makes investing in dividend stocks an even better deal. It's a good point. Thank you for the participant for bringing that up.
Thank you. Next one. What will happen with the value of our homes with what you've said about real estate not being a good investment or unaffordable for most young people?
Well, as the famous Yogi Berra said, it's very hard to make predictions, particularly about the future. I don't know, and I don't know what markets will do. All I can say with some conviction is that the glory days are over, and the price increases that were experienced in the past are highly unlikely to be experienced in the future. Now, real estate is already down, I think, about 20% from its high back in 2022 or 23. So it's already down 20%. Is it going to go lower? I don't know. Hard to say. Uh, don't like to make predictions about the markets.
Next one. Can you please explain what you mean by cash flow?
Yeah, cash flow is simple. It's simply how much cash you need to either pay the rent or pay the cost of ownership. So if you own, you've got maybe mortgage payments, you've got tax payments, you've got maintenance payments, insurance payments, utility payments. That's cash flow, right? What goes out of your pocket every month. So when we look at the difference to see if it's positive or negative, basically compare the cost of all those things I just mentioned versus rent. And if your cost of ownership is less than the rent, then your cash flow in comparison is positive. If your cost of ownership is more, then your cash flow is negative.
Next one. Could you speak to the same scenario, but with buying freehold home versus renting? Buying freehold home versus renting.
Um, yeah, basically what you find if you buy freehold, of course, is that you avoid the condo fees, but you still have other costs that the condo association picks up. So for example, if you own freehold, you've got to buy insurance on the whole property. And real estate housing insurance is rising dramatically because of all the threats from climate change. And then a lot of the maintenance that is included in a condo situation, you have to do yourself. So some you can handle yourself, like mowing lawns and things like that. Others you can't. The other thing is that freehold tends to sell for a higher initial price than condos, particularly in, say, townhouses, from what I've seen. So you're paying a bit more upfront to be free of the condo fees. In the end, my preference would always be to get freehold because then you've got more control over yourself. But in the end, I'm not sure that there's any great amount of difference in the total costs, the total cash flow.
Thank you. The next question is from Mary Deer. What is a dividend ETF?
A dividend ETF. Okay. Well, that might be the subject of another webinar. First of all, what's an ETF? An exchange traded fund is a kind of mutual fund, but it's sold directly like a stock. And as a result, it tends to have much lower fees than a mutual fund does. And what a dividend ETF or exchange traded fund is simply a fund that buys a bunch of high quality dividend paying stocks. They usually have some system format to choose these stocks. And these are conservative investments that pay typically today 4.5% to 5% dividend every year. And as well, hopefully the value of the stocks grow at the same time. But I think if you need more information, just do some Google searching on Canadian dividend ETFs. There's lots of them. And you'll see some good explanations.
Thank you. The next one is from David Welsh. Our condo fees include all common element, maintenance, and repairs. So how do your numbers change without that otherwise substantial cost?
Sorry, can you repeat that again for me, Robert?
Yeah, our condo fees include all common element, maintenance, and repairs. So how do your numbers change without that otherwise substantial cost?
Right. But condo fees do not include repairs to things like appliances in your own unit, usually. Or the fact that, after a period of time, if you want to sell it, you might have to replace the kitchen countertops or toilets or update bathrooms. So while condo fees do cover the building and the common areas, they do not cover your internal costs to keep your unit up to speed. So that's why I used 0.5% as the cost of maintenance rather than 1%, which is probably the cost, including many of those costs covered by the condo fees.
Next one, from Karen Rankin. Do you think that the housing market will crash?
No, I don't think the housing market will crash. And then one of the reasons why I don't think it will crash is because, hang on one moment here.
Pardon?
I think that Canada is underserved with housing. If you look at the number of units of housing per capita in Canada, it's lower than a lot of other developed countries. So I think that there's always going to be a substantial demand for housing. And I think that's going to keep it from crashing. Now, having said that, there are certain parts of the market which are getting badly hit, and that is the small condo market in Toronto. They built tens of thousands of condos, basically to be bought by investors to be used for things like Airbnb. And they're very small, one-bedroom studios and this sort of thing. Now they can't make the cash flow work anymore. So people are trying to unload these things and nobody wants them because they're too small. They were designed essentially to be Airbnbs, and they're not what families or young people want. So that market is really in trouble. But I think in general, particularly the single family market is vastly underserved in almost all major Canadian cities, as is townhouses. So I don't see the market crashing.
Next question. Anita Walden. Why did our government allow buildings to be built and do away with rent control? It is disgraceful. Concierge. Whoops. Don't know what that last word means. It is disgraceful.
Well, the problem is that if you kept in rent controls, nothing would get built because it just costs too much money to build them, and you can't rent them to cover your costs. I mean, part of the reason for the expensive housing we have today is that it costs an absolute fortune to build a new apartment building. So if rent controls were still in, frankly, there would not be any built.
Next one from Bill Tyson. How do real estate returns over the past 20 years compare with stocks? I think you had a slide on that.
Yeah, well, as I showed, basically the real estate returns were inferior to stocks. The average annual increase in housing prices was about 5.6% versus, say, 9% in a dividend ETF. And as one of the commenters said, and it was a very good point, from that 5.6%, you have to subtract the cost of ownership, such as taxes at 1%, all your maintenance costs, updating your house. And so your real return on real estate was probably closer to 3.5% per year after all these costs versus 9%, 7 to 9% for a dividend ETF, which basically has no costs. So the one benefit is that your capital gain on your housing is tax-free on your principal residence, but you can select investments that minimize your tax, or as I pointed out, in the case of dividends, might be almost nothing, and be a lot better off. But I want to reiterate, one of the reasons that housing was a good buy 20 years ago, 15 years ago, is that you could buy an investment apartment or small house for 20, 25% down. And with that, even with your expenses, because you were making the capital gain on the entire value, your return was perhaps 12 to 15%. And in that case, it was a good investment and a good buy, and it had been. But those days are over.
Next one. Topic might be outside scope of this presentation, but what do you think of the CHIP program? Is it advisable?
He's talking about the reverse mortgage program,
Right.
where you essentially use the value of your house to get income. And then at the end, when you pass away or you sell the house, the proceeds of selling the house pay off the debt that you've accumulated. With these, you have to look at the costs involved. How much is the effective interest rate that they're charging you for this convenience? Because you could do more or less the same thing yourself. If you own your property, you can go to your friendly bank and either get a new mortgage and use that to live off of if you need the money. And when you sell the house, you pay off the mortgage. Essentially does the same thing. Or you can get a home equity line of credit, what they call a HELOC, where you provide your home as collateral and you get a reduced interest rate as a result. So you have to look at the costs of these things and compare them. Typically, you're paying an extra premium for that CHIP, that basically home, what do we call it, a reverse mortgage, over essentially doing it yourself by just getting a mortgage.
Next one. Michael, please comment on Canada's current financial situation compared to that of the US after the housing market. Excuse me, I'll say that again. Please comment on Canada's current financial situation compared to that of the US affect the housing market. Thank you.
Yeah, well, a good way to compare the situation in Canada and the US is to look at the value of the Canadian dollar. Because the Canadian dollar, the exchange rate basically is there to adjust for the relative strengths of the economies. And back in about 2009, the Canadian dollar was at par with or even slightly above the US dollar. Today, it's trading at about 70 cents, hit 68 a few days ago. So it tells you that the Canadian economy is considerably weaker than the US. And therefore, when the economy is weaker, you're going to have people less able to purchase housing. But there's something else that happens, and that is the interest rates in Canada are lower than they are in the United States, significantly lower. because of our weaker economy. So as a result, you've got a situation where mortgage rates in the United States are quite expensive now. And they tend to buy in the United States, they tend to get 30-year mortgages. So a 30-year mortgage in the United States now is running about 7% interest, where in Canada, you can probably get a 5-year fixed term mortgage for maybe even under 4% today. So these things tend to offset one another to a certain extent. The other issue that they have in the United States, which is really becoming crucial, is the cost of house insurance, or even the ability to get house insurance in states that are really being hit hard by climate change, that being California, Florida, parts of East Coast United States. And if you can't get insurance, then you can't get a mortgage. So a lot of these things are going to be interesting to see play out over the next few years.
Next one. I notice you don't show condo fees in your calculations of home ownerships versus condominiums. Are you equating condo fees with home ownership costs such as utilities, upkeep, and as such not showing it either?
What I did in this case is I just used apartments or condos in the calculations. I didn't use standalone or single family houses simply because I didn't have the data to do it. But my experience as being a homeowner is that your costs of owning a home are pretty substantial, running around 1% per year when you look at everything that you have to pay for. Maybe my property is just too expensive, but it costs me a fortune. And so I find that you pay one way or the other. If you're not paying condo fees, you're paying these fees yourself. And as you get older, you got to pay for things like snow removal, maybe somebody to cut your grass, trim your bushes, things that you can't do yourself anymore. Like, I'm not getting up on a ladder to cut my cedar hedges. And I'm not getting out there every day to shovel out my driveway. So I pay for it. And if you add those in, they come pretty close to the condo fees.
Gail Robertson. I own a triplex in Little Italy. I live in one unit and rent two below market rates. Rents at below market rents. I purchased the house in 1998. There is significant increase in value. However, who wants to be a landlord today with capital gains? Is it worthwhile to try to sell the building with all the headaches of having tenants who do not want to move? I am getting older and would like to rent, but not sure worth the hassle.
Yeah, well, that I guess is a very personal question and point of view. Personally, and we're all different. I'm not handy. I fixed a toilet a couple of months ago. I was so proud of myself. I mean, to me, that was the technological equivalent of landing on the moon, being able to fix that toilet. But some people are handy and they love doing this stuff. And for those people, more power to them. I personally would never want to own a rental property and rent it out. I don't want the hassles. I don't want to have to deal with tenants. I don't want to fix broken toilets. It's just not something I would ever do. I would much rather invest my money in a dividend ETF and sit on my butt and not worry about it. So it depends very much, on your personal abilities and just how you feel about being a landlord. But as you get older, you might want to say, "Hey, I don't want to do this anymore." In which case, you do your best to sell the property and move into a rental unit for yourself.
Next one. For those of us who are, and it's a long one, Michael, for those of us who are under 40, who have not yet broken into the market because we have been waiting patiently to see what the market looks like since the onset of COVID, but are ready to purchase their first home, i.e., single family home or townhome, on a single income with 20% down. Based on your presentation, it still appears that it would be ideal to purchase a home rather than renting over the long term. Is that correct? I agree that rental prices are absurdly expensive. Luxury rentals are exploding in Wellington West, Westboro, and very high price tags. Paying those rents make it nearly impossible to even own a home. Excuse me.
Well, you know what? One of the main benefits I've always found about home ownership, and I say the same thing to my daughter who's looking at buying, is that it is essentially forced savings. It forces you through the mortgage payment to save up over time. And that's a good thing because otherwise, what happens, even if you can rent for less than the cost of owning, is you spend the money. You don't invest it. My theory is great about investing as long as you invest. And if you actually invest, then you might be better off renting and investing the money. The problem is 95% of people spend the money. So whether or not this is a good time to be entering the market, I don't know. Nobody knows. But if you're young enough and you're looking at the long term, then I think it's a good idea. And I'm certainly going to encourage my daughter to do it just as soon as she can afford it.
Next one. I'm surprised to hear you say that you cannot find anything suitable in order to put your house for sale. Feel free to pass on answering if this is too personal. But if the issue, but is the issue location? Prices too high? Is there a problem looming that retirees won't be able to sell their home once they're ready to move on?
No, the reason we can't find any place to move to is because we're too damn fussy. Um, we want to move. We want the next move to be our last move. We've moved all our lives because I was in the Foreign Service. The house that we have now is a bungalow, which is great. But as I mentioned, the lot is way too big. We have almost 20,000 square feet, just way too much. And we want to move to basically a place where we can walk to things. But that means a multi-story house of some sort, and we're getting old. And so we need to find a place that will accommodate us in another 10 years or so. And that's hard to find. But some point we'll find it. And then when we do, I think this house will sell pretty quickly because, as I say, it is a bungalow and bungalows are in demand.
Next one. Re-conclusion 2. You say if you invest cash flow saved by owning, you are better off. But I thought cash flow was lower than owning. Or did I get this wrong?
What I said in conclusion 2 is that basically, if you don't have a mortgage, then it's, either or. It's pretty close between renting or, not having a mortgage. But if you do have a mortgage, then it looks like renting can be cheaper. So it just depends on where you are in that ownership cycle, if you've got the mortgage or not.
Next one. Are there ETFs that focus on rentals? Thank you.
There are. There are in the investment market are things called real estate investment trusts, known as REITs. They're not ETFs, but they are companies that build apartment buildings. There's two actually in Ottawa. There's one called InterRent, and then there's one called Minto REIT, which is part of the Minto organization. And you can buy shares of these things on the stock market. There are also some ETFs that invest in REITs. And there's one from Vanguard, there's one from BMO, there's one from iShares. I believe, for example, the iShares one, the symbol is XRE. And there they own a basket of these real estate investment trusts, not all of which will be apartments. There'll be a variety of things, shopping centers, retirement communities, whatever. So you can either buy the individual REITs, such as InterRent and Minto, or you can buy an ETF that owns maybe 25 different REITs.
We're almost at 11 o'clock and we still have 10 questions. We've already answered 25, so there's a lot of interest, Michael. The next one is, and it's a long one, so I'm going to go slowly. I'm a real estate investor. Cash flow should read liabilities or cost when considered as an expense. Condos are terrible investments. Condo fees are just the burning of your money. Worse, you are very limited by bylaws. Own your own home whenever possible, and whenever you travel, list the home on Airbnb and write off half of your expense on your home. Reference rent control. That's a bad idea. That's a bad deal for real estate investors. We get impacted by interest rates and need to adjust rent to match the market when it changes. Ontario and BC is bad for rent control and limits landlords. Many investors are moving their businesses to U.S. red states in the Sun Belt.
Well, I think my comment in that for that is thank you for those insights. It's good to hear from people who are actually in the business and know what they're doing, and I would not disagree with anything that the commenter said.
Next one. The thing is, the glory days of equity investing could possibly be over also. The massive run-up of the market since 2008 stock market crash may have gone too high also. So the market may not crash, but investors could have just a bumpy ride as the future of home ownership also. What's a person to do?
Well, and that's a good question. That's a very good point. When it comes to predicting what markets will do, though, it reminds me of something I've read and come to believe. There was a fellow by the name of Peter Bernstein, who was a very good writer about investing. And he said, you know, there's only two kinds of investors. There's the kind that know that they don't know what markets will do. And then there's the kind that don't know that they don't know what markets will do. I used to be the second kind, and now I'm the first kind. Now I know I don't know. But having said that, the commenter is right. We've had outstanding returns over the last, 16 years since 2009 crash. Rather than trying to figure out what the market is going to do, what I've taken on as my approach is to try to be careful by investing in things that are going to continue to pay me no matter what the market does. So what do I mean? Well, dividend ETFs, where you know you're going to get your 4.5%, 5% regardless. Certain dividend stocks, preferred shares, things like that, that even if the market tanks, I'm going to continue to get my, as I say, 5%, 6%. And going forward, 5%, 6% a year might look very good for the next 10 years.
David Welsh, I just checked dividend tax rates in Canada, and it looks like non-eligible dividends are taxed at 15% and eligible ones at 9%. Where does the tax-free 557K come from?
Basically, if you look at the tax rates for Ontario, and it differs for every province, so I'm talking about Ontario. In 2024, and I don't have the 2025 in front of me, but in 2024, you could earn a taxable income up to $55,867, and the tax rate on eligible dividends, which are basically almost all Canadian dividends, the tax rate on eligible dividends was minus 1.2%. So I rounded that up to 57,000 because that number goes up with cost of living every year. So basically, you can have a taxable income in Ontario per person and pay nothing on eligible Canadian dividends. Now, that does not include American dividends. American dividends are not eligible. They pay the full tax rate. And there are other certain kinds of special dividends that are not. But dividends from almost any major Canadian corporation is a eligible dividend. If you want more information, go to a site called taxtips.ca, and they will break out for every province and every income level what the tax rates are on regular income, capital gains, dividends. You'll see it all there.
Thank you, Michael. Next one. I am a 62-year-old woman who needs to either buy a home or get a mortgage after many years of being mortgage-free or rent. What would be your advice to me if I should choose to buy? What is your advice on HELOC versus mortgage?
Yeah, well, I think you have to compare the essentially what the costs are, what the interest rates are, one versus the other. But what I would suggest is that you talk to an insurance broker rather than to a bank, because the insurance brokers have a much greater range of what shall I say, approaches to finding you money. So somebody like Ottawa Carleton Mortgage Brokers or various others that are here in town, they are usually very good, and they usually can find you better deals than you'll get from the bank.
Next, how will the 250K capital gains cap proposed by the Liberal government, by the way, I think it's not going to come into effect, affect home ownership, especially for those who have owned their homes for over 2 decades?
Well, first of all, as you said, Robert, it's not coming into effect. It's been shunted till at least 2026. And if there happens to be a new government, I think that that thing will go away. The other thing is, though, it does not apply to a principal residence.
Yeah.
It only applies to, say, secondary residences, investment properties. So if you're talking about a primary residence, it does not apply. There is no capital gains tax yet, at least, on primary residences.
Next one. Is investing sound given the current relationship and possible tariffs from US? How would these tariffs impact on us Canadians? Wow, that's quite one.
Yeah, I'll let you answer that one, Robert.
I'm really not qualified to answer that. How about you, Michael?
I'm not qualified to answer it either, but by summation would be not well.
Yeah, yeah. I think we all tend to agree. Next one, Karen Brawley. Just excellent presentation. Thank you very much, Michael. Okay, we'll go to the next one. Jérôme Bernier. Merci, Michael. Next one, Mario Bartolini. Thank you for this information and a frank presentation. Louise Klein, what are the ETFs that have a basket of REITs other than XRE? Now I'm confused with all of those acronyms.
Yeah. Well, I could give you a couple, but it's easy to look up and just Google REIT ETFs. But I think their symbols are all pretty similar. I think there's VRE from Vanguard, ZRE from BMO, XRE from iShares. And then there's another one that's an actively managed one called RIT. So their symbols are all similar to that. Having said that, I think rather than investing in these REIT ETFs, people may well be better off investing in just a broad dividend ETF, which includes some of these REIT ETFs in it, because they're things that produce monthly cash flows. But my personal approach is to use the broader ETF, the broader dividend ETF, rather than the specific REIT ETFs. Just my personal preference and not a recommendation.
Great. We had a couple of comments. In addition, Michael, thanking you for your excellent presentation. We finished the questions. Thank you, everyone, for asking the questions. It was quite a number, and they were quite interesting, which shows, Michael, a lot of interest in your presentation. I will then move to closing remarks. Thank you for your participation, all of you, in today's webinar, and a huge thank you to our presenter, Michael Fine. I want to remind you to keep an eye out for our follow-up email, which will include information on how to access the recording of today's webinar, as well as a copy of the presentation slides. Remember, you can invite non-members to attend our webinars and try us out as our guest. To register for upcoming webinars, please visit the Ottawa Branch website at nafrottawa.com. Thank you, everyone. We hope to see you tomorrow for our webinar with Elections Canada. Merci beaucoup à tout le monde et au revoir. And again, many thanks, Michael.
And thank you, Robert, so much for being such an excellent host.
Okay, we will sign off.